Good afternoon. This is Ken of Tortoise Capital with a review of the weekend trading report for September 15th, 2018. So the market is in bullish quiet conditions. That's favorable for the long side as we're pushing through to new highs in the market. That's very favorable. We're overbought on both the long-term and the short-term NDX for the annual and the 10-day. That's very favorable for the long side. In the market mosaic, price relative to the 200-day moving average has improved to white bullish at 6.08%. Slope of the 50 is red neutral, still some weakness there longer term. ADX is below 15, so it's a weak trend. A breakout to the upside would strengthen that ADX with the bulls in charge, and that means that there's plenty of room for the next leg up because of the relative sideways conditions of the last 10 to 14 days. The risk index is the 30-period moving average of the VIX divided by the 10-period. 1.0 is the boundary between risk on and risk off. Currently reading at 0.961, so we are into risk off, and more conservative assets are favored. The risk Z is when we take that score and look back the last 5,000 trading days, compute the standard deviation and average, and then that gives us the risk Z score. So we're at minus 0.55. That is a little over half a standard deviation below the long-term average, meaning that it's still somewhat risky to be involved in this market based on volatility alone. When we look at the 90-day histogram of this, though, we see a low, a nice move up to 1 sigma, down to half a sigma, touch half a sigma, and resuming. Both of these moves here on the long side in what we would call the spring of risk Z, and that one in the spring of risk Z were excellent. This one where we went summer, fall, and then back into an India summer was also favorable. So if the trend continues and volatility continues to diminish, then this is setting the stage for a reasonable upside move to the long side there. These are the current holdings for September for blended monthly rebalancing for those portfolios. They are still the leaders going into the weekend. Then these are the leaders in these different symbol populations here. You see it being dominated by some pharmaceuticals, a little bit of tech, and a consumer staples. Theoretical exposure of ETF2 is 40% in the asset allocation model. This is the blended monthly rebalancing, and you can see we're about evenly split between buy and cash. That's price relative to the 4-month moving average is the cutoff there. You see that real estate, small caps, and tech have been leading the way, although they all gave back a little bit this week. Diamonds stand out as a large cap winner who gave back the least, so those large caps are still kind of favorable. I would look for a continuation pattern in DIA if that were the case. No real winners elsewhere in the world, and so that makes, on a relative basis, the Dow and the mid caps actually stand out pretty well. And then the Dow on the 1 month and small caps on the 1 month still performing very well. In the ETF 32, we're seeing some of the defensive plays like discretionary healthcare and utilities doing pretty well. So we're going to add XLY, XLU to the continuation patterns. Some give back in tech, but you can see basically everything international is still getting crushed. If there's more market weakness, then I would expect these to continue to lead the way downward. So things like emerging markets, Asia less Japan, and Australia showing continued signs of real weakness along with China. So that would be the first place to take a look at. In the Dow 30, Some leaders in here: Johnson & Johnson, Home Depot, and Pfizer. That's still continuing to look pretty good. Coca-Cola and ExxonMobil showed some short-term gains. Boeing and Caterpillar trying to reverse their longer-term weaknesses. But right now, GE and Intel still just looking very weak. So if we saw weakness in the market and their sectors, then we would look to those to be opportunistic shorts. In the sector spiders, utilities, aerospace, consumer staples. See, healthcare hasn't lost much and is in the number 3 position. Oil and gas, capital markets, materials and mining. That's why Australia was suffering, because they're so closely aligned with that sector. ETF Max, the winners this week: utilities, small caps, consumer staples, small caps. Some losers here among biotech. In the market health check, the vertical blue lines are 10, 20, 30, 40, 50 days of look back. The horizontal red lines are what used to be resistance levels and are now support levels, and become targets on the way down if this support breaks. See, the 10 period regression line from blue dot to blue dot is basically flat, but we're near pushing the upside of that. The 30 period is sloping up. That's the health of the trend. So we had a little narrowing here 20 days ago and then resolved to the upside. The pullback is creating a series of higher lows. So a low, a higher low, a higher low, a higher low, a higher low. That's continuing to just oscillate along the north end of the river. The fact that we get 2 PSAR dots on the bottom and a strong close on Friday, this has some real potential. We're still above the zero line, so we have a long side bias, and then this is finding some support. If this starts to hook back up, then this becomes like an Indian summer, and that becomes a very strong signal. The last time it did that, it stabilized and then got some gains and then crossed back over and then got a nice bump of about $5 here. So there's room for another $5 move there. ETF regional report. 4 of the 10 indexes, all the U.S., are still on buy signals, everything else on cash, thus 40-60. So the U.S. is stronger than the globals at 80, stronger than 53. Inside the U.S., it's technology, large caps, small caps, mid caps. 2 weakest sectors, Latin America and emerging markets. Inside the S&P sector spiders themselves, it's utilities, healthcare, and discretionary. Market health check, U.S. is above average, and large and small cap growth exceptionally strong. Europe is still mostly weak. Asia even weaker. Some things above average here in the other asset classes: treasuries, bonds, real estate, and private equity. Mexico and Canada doing well, I think, on the backs of energy and maybe some positive signs on NAFTA getting resolved peacefully, but Brazil getting smashed along with Latin America. Potential new emerging strength here in Mexico, as we just saw in the previous chart. So let's look for a continuation pattern there. Minimum volatility and dividends, kind of like those. Shifting to the daily report now. No signals in channeling and overreaction. You can see the 10-day max pains we saw. Intel was of interest before, so I'm going to really consider that. Let me add some, in case of weakness, what I'm looking at is EPP, Intel, GE, GS, basically the 10-day max pain guys. In the auto framer, Intel, Goldman, and Walmart. Now notice these are in a critical state, so they show up in a couple spots. That they're so deeply sold off that the rebound to the 10-day high is offering good reward to risk ratios, and a couple of those are dojis. But then if they fail, the reason that they're interesting on the downside is the same reason that caused them to sell off so sharply. Some auto framers here. Let's look Asia less Japan and treasuries. There's a 5DD in the VIX. Triple screen and a 551W in Walmart. And that's also channeling an overreaction. So Walmart's definitely got to be on our list. Disney is a Max Payne and a channel. Johnson & Johnson and American Express are both the most Z stretches above their Bollinger Band mean. So those become interesting to us as either a continuation or a reversion. So that's in a critical state. Intel and Asia less Japan on the stretch the other way. So these tend to come in clusters. Asia less Japan is on the most expanded pinch box, and that means it's had like a 30-day continuous directional move. So that's going to be that's also a stretch. And then the most compressed pinch boxes, this gives us super pinches essentially. IBM, UTX, XLF, JPM. Some auto framers, Walmart and Goldman. Got those already. Regression line fractals. You see Intel is 12 ATRs below its fair value. Chevron is 4.5. So I really like Intel for that reason. Silver of interest. Intel. Also, again, once more. As far as overheated or beyond their fair value, Merck, Procter & Gamble, Johnson & Johnson. That's really the whole XLY complex. Daily squeezes. Walmart and Chevron are of interest. CVS, sorry, not Chevron. In the Four Seasons of MACD, what I like to look at are those things in the spring that have started to roll back up but are still below their Bollinger Band mean. That gives them lots of room for gains. So Coke and UTX. Some are continuation patterns. I like Nike and Pfizer because they're above the zero line, sloping up, but they're still below their Bollinger Band mean. That means that they've had a sharp pullback, but are still otherwise very strong. So there may be an opportunity in that area. Those in the fall that are still above their zero line could be of interest. But everything in the fall, I'm going to go back and take a look at these as a waiting for them to recover. Well, if they go below their Bollinger Band mean and then cross back above, like Merck and United Health, then that becomes very attractive as well. Let's see, Merck and United Health. And then in the winter, these are all the ones that are that have been failing very badly. So if there is weakness, then this is a good set of candidates to pile on. So Travelers and Procter & Gamble could be of interest there. Okay, in the ADX print, the ones that have been exceptionally strong and directional become good fraud candidates and maybe good for continuation plays. We've already seen these: Merck, Pfizer, and Johnson & Johnson. The ones that have been the least directional, the choppiest, and these could be some channelings that could be getting ready to go. We look at 3M, Boeing, and we've already seen these other ones to work on. Just grinding slowly north. I like the higher lows and postured ready to go. The next one is still $5 ahead in terms of percent strength, and we are not exaggerated on our strength profile. So this is a very grinding bull. It's not the fear and madness of crowds yet. Extremely low volatility. It just dipped back into quiet. That's good for the long side. Declining volatility, you see all the way down. And by historical norms, not much of a steepness to the slope, still just around, still below 1 standard deviation, but tilted up, which is still favorable. The 10 is postured, ready to resume. The 30 and the 90 are both signaling strength. We've been riding the upper edge of that river, for 30 days now. No reason it can't continue now that we're above the previous hump. All the Z-scores for the holding periods of the last X days are all so low that there is no sign of overheating on this. This is a grinding, quiet bull. And just some reference charts. Okay, I'm going to go through these now on my own and prepare my trading plan, and I'll post some trade frames in the chat room and in the weekend webinar and podcast for the silver subscribers. I'll go over some of these in greater detail, but that's kind of what a structured approach to planning looks like as I'm using the report to identify those symbols that I really want to work on. Okay, this is Ken at Tortoise Capital. Keep your risk measured and your powder dry.